Welcome to Real Estate Investing for Professional Men and Women, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hi, everyone. This is Gary Wilson, and welcome to this week's podcast, Real Estate Investing for Professional Men and Women. We got a special guest today I'll introduce here in a second. But just as a reminder, if you haven't yet subscribed, go ahead and do so. It's the Real Estate Investing for Professional Men and Women is on, iTunes, iHeartRadio, Stitcher, probably 75 different channels. And a lot of you have been looking into joining. We have this great community we've been developing for the last probably almost 5 years now. And a lot of folks just like us, other professionals in their fields, dentists, engineers, pilots, teachers, firemen, policemen, chiropractors, and a lot of us are business owners. A lot of you are business owners, and that really helps a lot. You got that entrepreneurial mindset. And just to give you the theme here is where we do invest ethically and honorably in the areas that we do invest in, so that it is win-win for the communities, for the tenants, for us. Everybody wins. And that long term, I can promise you're going to make a lot more money doing it that way anyways. While we do use some creative purchasing techniques, it's really more about getting you on a cash basis as fast as we can. And then you can use other creative purchasing techniques once you're on a cash basis. It's kind of a neat concept, but it opens up more doors. And so it's just you shift from one type of purchasing to another type of purchasing that gives you more strategies and puts you more in control. So in any case, feel free to join the community. Go to mybusinessservices.com, click on members area, and you can read all about it. And if you want to select one of the two types of groups, feel free to do so. Glad to have you on board. So in any case, today we got a special guest, Matt Faircloth. Matt and I are both members of the same mastermind group called GoBundance. We got a women's group and a men's group, and the tagline is for the men, healthy, wealthy, generous men who seek to lead epic lives. And a lot of pretty good guys in there, a lot of professionals, business owners, all entrepreneurs, and a lot of us do invest in real estate. And it's not like the end all be all. I mean, I have people on the podcast that don't invest in real estate, but they add value to the podcast. So in any case, hey, Matt, welcome aboard, man. I appreciate you taking your valuable time to do this,
Thank you, Gary. It's an honor to be here.
And I like the background too, the DeRosa Group. You got the superhero back there, American flag.
Yeah, I filled it up. It's with the American flag is an interesting topic. Not enough people bring it up, but I actually collect American flags. Cool. For properties. I mean, I've done a lot. I've been in business for 15 years, so I've walked a lot of abandoned homes that used to be somebody's house, and there's collectibles in some of these houses, and that's something that there's like byproducts of investing in real estate, and finding neat stuff in a house is something that sometimes comes up. It's not why I do it, of course, but it's just a little side perk, right? So. Yeah. American flags are something that a lot of people had hanging in the garage or in their basement or whatever. And some of these houses are old enough to where I got sitting here on my desk. I'll see if the camera will show this. This is a 48-star American flag.
Yeah.
And this little guy is probably 60, 70 years old. And he sits right here on my desk. And I've got a couple of framed 48 stars in my lobby. And because people know I collect American flags, I've had a soldier that was in service in Afghanistan sent me 2 flags that had been inactive. The flags themselves have been in active duty,
right.
In that. So yeah, I've become a collector in that. And this one is old as well, and it's got some stains on it and stuff like that too. But it's one of those, I became a collector once I got into real estate because I found that a lot of people just had flags in their basement, and it's always been something that I thought it would be fun to put on display instead of just laying in a pile of dust in somebody's basement. So
yeah, that's interesting. Yeah, well, I tell you what, if you wouldn't mind, if you could go ahead and keep going. If I what I want to do is, I know you've got a great book out there about raising capital, so some people may already know who you are, but for those who don't, kind of keep going with where you're just going with the flag. Tell us a little bit more about yourself, because it'll bring context to what we're going to talk about next.
Yeah, we probably don't want to talk about flags for a half an hour. We could, but it's not necessarily. Maybe it'll give your audience a little more meat than that. So I quit my job in 2005. I was a traveling sales rep for a company called Ingersoll Rand. And I just decided to invest in real estate full time. Not that you have to do it full time to be successful in it, but I decided that that investing full time was what I wanted to do, and to build a business around investing in real estate. So since 2005, I've done single family home deals. We've done a lot of fix and flips. We own an office complex that I'm sitting in right now in Trenton, New Jersey. We have gotten into since like the 2010, 2011 range, we got into more multifamily rentals, and we've done very well with it. So we've been purchasing a lot of apartment buildings, small and large. We bought just last week, we closed on a 222 unit in Lexington, Kentucky, was our most recent purchase.
Nice.
So yeah, so it's been fun, and we've been able to do a lot of our work with private money, either as a loan or as equity, which enabled me to. I've learned the ropes of working with private capital, and it enabled me to write a book for Bigger Pockets called Raising Private Capital, which is about how to work with private investors in some form or fashion. And the book was a passion of mine. It's something that I feel like we need more of in this country, because a lot of people that have extra cash up until now have been relying upon Wall Street to help them reach their financial goals. And not that it's a bad place to invest, but it's not the only place to invest. And my book talks about how people that want to passively invest can effectively put their money into real estate, what they can do to protect themselves, and how people like myself that are active in the business can find more people out of their network, or vice versa, that want to put their money to work in the real estate business.
Yeah, well, I like that. If you wouldn't mind, let's go ahead and jump into some content. So I love the background, love the history, and I've actually been to Lexington, I think, on 2 different occasions. Great town. And a lot of history there too, by the way. you know, yeah, especially if you like horses. So, in any case,
horses and bourbon, that's what they got, and quite a bit of both, you know.
Yeah. But if you wouldn't mind, give an example, if you don't mind, of one of your deals where you raised, maybe 2 examples. One where you were offering like an equity play, another one maybe you were offering profit sharing. And there's all kinds of ways I've seen it done. I've seen actually deals where you combine multiple strategies, like share of profit, share of equity, and of course an interest rates, like a loan, hybrid loan, where you get these other benefits depending on how good the deal goes. And I just want to expand people's minds and let them know that it's not linear. Sometimes you can think exponentially with this stuff,
That's what's great about this, is that there's not one flavor of ice cream here. You can get very creative in the way that you structure deals. So we've done just straight private loans. Let's say I just say, hey, Gary, I'm going to buy this fix and flip over here. I'm going to do all the work. I'm going to buy the property, do the construction with my team. I'm going to put it up for market for sale, and I'm going to pay you 9-10% on your money, and you would just produce that money out of your own pocket or out of a retirement account, because you can invest in real estate with an IRA. So you put your IRA into that deal, and we would either pay you monthly payments, or we would just pay you all your interest at the end, one of the two. And then the deal would sell, and you would get your money back and get on down the road and hopefully do another one with us. You're pretty much being the bank for a real estate investor in that circumstance. So that's a private loan, and you're protected with pretty much the same documents that a bank gets protected by. You're protected by those things too. So a note, a mortgage agreement, all those things are all protecting you as the investor. The next arrangement is private equity, which is where I say, hey, Gary, I'm going to go and buy this apartment complex over here. We're going to pay, I don't know, $2 million for it. I need $400,000 in equity to allow me to purchase the property in cash, not a loan. I'm going to borrow $1.6 million from a bank, and I'm going to get investors to buy shares of that apartment building, and I'm going to sell enough shares of the apartment building so that I can have $400,000 so I can buy it and operate it. Okay. I'm really oversimplifying the money right now, but that's
okay.
In essence, what you're doing is you are selling shares of the apartment building, and people are buying it as if they would be buying shares of Microsoft. Instead of that, they're buying shares of an apartment complex. But what's great about that is they get to own the company directly, and there are many, many financial benefits to owning real estate directly in your portfolio. Many, many tax advantages associated with it. So the investors get to reap all those tax advantages that real estate provides, such as deferred gains, cost segregation studies, accelerated depreciation. There's ways to shelter some money you make in real estate, and make money without having to pay as much tax on the money you make on the equity play. The third way, now this is you alluded to this. That's the first two, and then the one that's in the middle is the hybrid, which is what we call a joint venture, where you might be loaning me money for a deal. We did this in Philly, where we built a bunch of townhouses in Philadelphia. And so investor came in and put in, I think, $290,000 out of their IRA, and that money went in as a loan to the company, but the loan was coveted with a share of profit as well. So they got paid, I think it was like 8% interest on their money plus 12% of profit. And it was a lucrative deal. We made a significant profit on the deal, and the investor got, in 10 months, their 8% came back, of course, 8% return on their money, annualized. So in 10 months, that was probably about a 7% return. But on top of that, they got another 23% on their money in share of profit. So they walked away with about 30%, between 28 and 30% on their money in a 10-month period. Which was phenomenal return for them. Now they're at risk a bit, because if we didn't make any money on the deal, they wouldn't have made as much. All they would have been guaranteed was their interest on their money, but at least they got a share of the upside. And if they're willing to take that risk, there was a big reward for them.
Yeah.
But those different, bottom line, Gary, there's a bunch of different ways you can structure these types of private transactions. There does not need to be one flavor of ice cream. There's different ways you can put it together.
Right. And the thing is every property is unique. Every person's unique. Every transaction is unique. So the thing is, once you learn the principles, like if I'm teaching, I try to teach things in a linear fashion, like learn this independent of everything else. But then what you do is, once you learn that, you go into production, you realize, I can combine this and combine that, and really, satisfy the needs of all the people involved, and make sure, of course, you're getting a good deal out of this yourself. We've even gone as far as, one time we partnered with a commodities broker from Wall Street, and we literally created a closed-end mutual fund. That means it was, people bought shares, and we bought portfolios of properties, and yours truly got all the commissions on those deals, and the property management contracts, by the way. And so it was really neat stuff. But hey, if you don't mind, you mentioned earlier, you mentioned Kentucky, and you mentioned Philly. If you don't mind, where are you geographically located? Number one. Number two is, what other areas of the country where you've been in investing, and share a little bit about that, because I want people to recognize that the fundamentals of what they are, it's like natural laws. They don't change. You may apply them differently in different areas, but if you could touch on that, where you are now, and then where you've been to invest, and where areas you might like to go, and how strategies might differ based on the different areas, that would be awesome. Because we got people from all over,
Yeah. So you want to go into just different strategies that you can get into when you want to invest, correct?
Yeah, and based on how does geography affect that, or how does geography dictate what approach you might take? Like San Francisco, very expensive. Less than Kentucky, not that expensive.
There's two different ways you can play, I think. Because I've had people in San Francisco. I was teaching a webinar for Bigger Pockets last night, and we were talking about evaluating rental deals. And somebody was like, "Well, I'm in San Francisco. How do I evaluate rental deals here?" And the answer to that question is, you don't do rental deals in San Francisco. You got two choices. You can either invest. I think let me back up. Every market in the U.S., I think, has a way that a real estate investor can be successful in that market.
Yep.
You might not be geared up to be the real estate investor that's successful in that market. I would say that there is a way to be successful investing in downtown Manhattan, right? But if you're not able to throw around $50 million, you might not be able to be successful in downtown Manhattan. I'm exaggerating, but let's say it's not 50 million, but it might be, maybe 5 million is what it might take to be super successful in downtown Manhattan as an investor. So you might not have those resources, but I don't think that you cannot be successful in certain real estate markets. I think that every market has an equation. So you either need to figure out the equation for the market that you live in and invest in your own backyard, and say, okay, I live in San Francisco. Maybe this is a good market for new construction or for fix and flips or for something. There's got to be a way you can make money in San Francisco. I refuse to believe you can't invest in my market. Well, you might not be able to do C-class buy and hold in San Francisco. I get that. That might not be there. So you either need to pick a strategy or pick a market and accept that that market is going to have a specific strategy that works. If you pick a strategy, you got to go find the market that works for the strategy you want to be in. For us, we want to be in C-class, which is like, solid workforce housing, blue collar workforce housing markets. That's the housing we want to provide with mid-sized multifamily apartment buildings. That's what we've been successful doing. We've done other stuff. The markets that I'm playing in are starting to slow down a bit on fix and flips and stuff like that. So we're not going to be doing as many fix and flips. And you know what else, Gary? You can only do one or two things and be successful in business. Yeah. So we don't want to do 8 things, even though we could, but we're going to just focus on C-level apartment buildings for the foreseeable future. That's what works for us. So we go forth and seek markets that are very friendly to C-class workforce housing. Lexington, Kentucky happens to be one of them, but there's many other markets that we have looked at or that just work in general. We don't think that we found the secret sauce in Lexington. There's other markets that work in the U.S. That's just where we've built our roots, is there. But to sum it up, you either find the market or you find the strategy, one of the two, and then you find there's a market and a strategy. You find the other one once you've chosen which way you want to go with it.
Yeah, it's funny. I always tend to lean towards the smaller markets because there's usually less regulation, costs are lower taxes. It's just easier than the bigger the towns, the bigger the cities. There's more hoops to jump through, red tape. Just all the municipal stuff, the inspections. Just my gosh, it just goes on and on. Landlord-tenant law tends to be tougher in the big cities on owners. Out in the smaller areas, it tends to be easier on owners. It's just been my experience. But by the way, you mentioned something really, really critical. I know it's not the main part of the subject, but the whole thing about focusing. One of the most difficult things a lot of us entrepreneurs have in life is when we discover something new, we just want to just go after it. And if you do that too many times, yeah, you're right. You got 8 things going on. But the reality is you can be more successful if you just keep it to like 3. That's my magic number.
How many fix and flips do you think Sam Zell did?
Oh gosh, I don't know.
Not very many. I think he just bought a lot of multifamily rentals, and he's super successful because he stayed in his lane, and I think it's something we can learn from people that, stayed in their lane and built big success. And I think that if you look at super successful entrepreneurs in real estate or other areas, if you look at them, most of the time they've focused on a thing, and some of them focused on a thing, got successful in the thing, and then went on to the next thing, and that's okay. Right. People like Mark Cuban are an example of that. He wasn't just a one-trick pony, but he typically invested in this worked. Okay, let me try this. And as you get big enough, then you can build a team around yourself and try different arenas. But when you first get started, I think it's extremely important to stay in your lane and not try and wear too many hats. And unfortunately, Gary, I know by experience that doesn't work. I've done it. I have a propensity to shiny nickel syndrome of chasing the next shiny nickel. And I think a lot of other entrepreneurs do. And it's exciting. It's fun to go and look at the next thing and talk about how we're going to make lots of money in the marijuana business on top of other ventures that we're in, because that's the new pioneering thing. That's a thing that a lot of people are running with. But I think I'd be better off just staying in my lane and sharpening up my saw in the lane that I'm in, and then eventually expanding into something else once the venture that I'm in is done.
Yeah, I agree. I made over all the years, I definitely did some flips, but I did way more rentals because I just did the math on it. I'm like, well, this is where I'm going to build a long-term wealth and income.
Yeah.
Flipping, you're still trading time for money. It's fun to do it. You get big checks, but quite frankly, long-term, it's the rentals to help you build a foundation upon which you can do other things,
Yeah.
Yeah.
You can be successful flips too, but if that's your thing, I mean, there's people like my friend Jay Scott, that have been like uber successful in fix and flips. But he systemized it. He built a business around it. And he's done, I don't know how many flips he's done, but I'm sure I think it's astronomical number of fix and flips in that. And I think that there's something to be said for whatever the strategy is. And I know wholesalers that are closing 20, 30 deals a month, right? I don't discount that either. Not the angle I want to take, because for different reasons I don't want to wholesale. But whatever it is, stay in your lane and build it. And I think that's where success is. Not like, let me dabble in like 8 different things. It's fun to dabble. Believe me, I've dabbled a lot in life, and it's fun to do that. But it's more boring, but way more successful and rewarding to stay in your lane. So.
Yeah. Well, between wholesaling, flipping, and owning rentals, the one thing that you can't get from flipping and wholesaling is ownership, which leads to equity long term. Only holding rentals can do that.
Right. Yeah.
Yeah.
Massive cash flow. Your flip business likely will not continue to pay you if you go and move to Italy for 2 months or something like that.
Yeah.
But your rental business will if you build the right systems around it.
Yeah.
So.
Well, it's interesting. I can pretty much tell you where every penny I ever made with rentals is or went, but with the flips, I couldn't tell you because I spent it, buying boats and things like that. So,
yeah, sure.
Yeah. If you wouldn't mind, you said you've been at it for about 15 years, and what's interesting is that goes back to pre-recession. So, if you could talk about time limits. So, you've been through now a cycle, literally up, down, and back up again. And maybe some lessons you learned there, or things, again, back to the strategy, because I want people to recognize that you can always invest, not just geographically where you are, you didn't have the right strategy, but also economically where we are. Because I noticed early on, real investors, they were still investing. They didn't care what the economy did. I mean, they cared, but they just want to know what it was doing, So if you might touch on that, it would be better.
Sure. Well, I think that when we were around, we were investing. We were fairly new, and so we didn't really know what we were doing, but we were still doing it. During the crash of 2008, we were, active. And I think that the way we were successful through it was by paying attention, watching the market, and responding to it as things changed. And a friend of mine gave me something, which is a great, mantra, is you cannot control the market. You can only hope to participate in it. Because the market is way larger than you and me. And people that think that they're going to try and sway the market one way or the other, you're wrong. I mean, even the big guys can't. Like Sam Zell cannot sway the market,
Right.
And he can only participate in it. Yeah, and that. So I think that you've got to pay attention to the market and try and make decisions that are based on current market conditions, not crossing your fingers and hoping that things are going to stay the same or change or whatever it is. So when things started to dip, we got into short sales because there became a lot of underwater properties, and so we learned very quickly how to negotiate short sales on real estate. So that's something that we got ourselves into. We got heavily into rentals in C-class areas because we found that although the bottom fell out of a lot of areas, C-class real estate rents didn't even blink because most blue-collar tenants can easily find another job if they lose theirs, but a white-collar tenant is going to be much harder to find another job because they're used to the earned income they're making and stuff like that. But the blue-collar tenant, if there is enough diversity of employment in the market that they're in, they can easily find another one. Maybe not in a day, but give them a month, they'll find a job. If they want one, they can find it. And so we found the stability of C-class real estate, which is why we're still invested there. And a lot of my properties are not, they're not the hottest Shangri-La properties you could ever think of, and they're not every amenity you can think of on the property. And we don't try and charge the absolute highest market rent that we can. We invest in steady Eddie properties that are not that exciting. Because they don't go up and they also don't go down. They're just because that's what I found by investing in Trenton, New Jersey, which is where I was when the market crashed. That this market barely blinked. Prices went down, but that's only because they were propped up on subprime mortgages.
Right.
is back then you could buy a rental property. I bought a 4-family on 3% down that I didn't live in. I didn't live in it. It was 3% down. Wow. investment grade mortgage, which that pushed the market up everywhere. So when that went away, Trenton corrected, but the rents didn't even blink. So that's what I've learned through the crash is you got to constantly monitor the market. And I learned the stability of C-class real estate.
Yeah, I agree 100%. There was a lot of really surprising lessons in a recession too. Like, for example, a lot of people who would have been homeowners if it wasn't for the recession were becoming renters.
Yep.
And yet rental properties are pretty much a static supply. I mean, you can increase it by building, but it takes time to do that. So there's a lag effect. And what I recognize is, my rents, I never did lower them at all. In fact, some of them went up because I had more demand than I had supply. And it wasn't like everybody, but it's just unique circumstances. But the other thing too is, like, I liked being around colleges, universities, hospital systems, particularly teaching hospitals where you're connected to a university, and you would get the interns or residents and nurses. But what was interesting is during a recession, college enrollment goes up, So it's just everybody else is crying the blues. I'm like, we some of our areas, we definitely paid the price. We didn't have to throw in a towel or anything like that. But like some of the single family homes, like you said, it got kind of tough because some of those people, they were losing their jobs and stuff. But for the most part, the apartment buildings, man, it just cruise right through, almost like no effect. It's crazy. So
they've gone up a lot in value over the last like 7 or 8 years since the crash, because of what you said. I mean, if you look at if you were to chart out home ownership in this country, it went way up in 2000 and up through 2007, and then dropped way off. And, a lot of people that probably weren't financially qualified truly to buy houses were buying houses, and so it corrected and went back down, but it drove up the value of multifamily, which has been good. But the thing is, that people still have to live somewhere. They just do. They can't move. They can move, but they got to move to another multifamily or to another home or whatever it is. So housing's been stable. What's going on in this country now that I think is interesting is that because of the housing boom, I think in the early 2000s, the cost of construction has gone way up.
Yeah.
In a heavy inflation and what it costs to build things. And so because of that, although we need more multifamily housing in this country, you can't build affordable multifamily housing. You can only build A-class multifamily housing. So if you're going to build an apartment building, it can only be at the top of the market on rents. It's very hard to build one that's affordable to middle America, and to the middle market. You can't build C-class housing without government subsidy, without tax credits and stuff like that. So it's caused pressure on B and C-class real estate, which has gone way up in value because it's in demand. And so I can go and take a C-class asset and then just clean it up a little bit, bring it up a little bit in the market, maybe not charge what new construction is going to charge, but I can do things like add dishwashers and washer dryer hookups and modernize a building built in the 70s a bit, to bring it up to the condition of the market. And it's cheaper than building it. And that's what we had. So we're going to have to do, if we want to continue to provide good quality housing, in these markets, is just take what's there, renovate it, and not double rents, but charge a little bit more for the value that we're in, but not in a good region.
Yeah, I agree. Hey, I wanted to go back to something earlier. I just started thinking of some of the transactions I was involved in. We had a mortgage and a note, just like you do with a bank, and we recorded it just like you do with a bank. But when you're doing some of these joint ventures, are you ever getting into syndication? Like, I know the one remember I told you about the closed mutual fund. We had to go through some security exchange stuff and get approvals, all that kind of stuff. Mm-hmm. Do you ever do things like that, or is it more strictly more simple than that? The reason I'm asking is some of the people listening, they're going to be, some of them, more sophisticated, and they're going to be interested in this stuff like this. They're going to want to probably reach out to you. But if kind of paint a picture as far as the technical stuff, what's involved, obviously note and mortgage, but any other things you've been involved in that people should think about?
For loans, as long as it is like an individual to a company, there's no requirement to register a loan with the SEC because it's not a security. A loan is not a security. And I've heard mortgage brokers try and tell you that the private loans need to be registered with the SEC. It's not true.
No.
I've looked into it. I've talked to SEC attorneys. I've read the SEC code. Someone just loaning money to another person is not an SEC trigger event.
Right.
Now, if you invest in equity and you are not active, meaning like if you are 100% passive, no activity on your own, and you're investing in a apartment complex or like a shopping center or whatever it is, that is an equity investment, you are registered, you are investing in a security, and it does need to be registered with the SEC as exempt through one of the exemptions. We use 506B. Is what we do. Now, syndicators can use different stuff and everything like that, but that's the one that we use. So bottom line is, yes, these things do need to be registered. Joint ventures, I have found, do not, because joint ventures are a little bit of a hybrid of a loan and an equity piece, and you can hitch yourself on some of the protections and contingencies that the debt side has to protect your lender. Instead of having to present it as straight equity, you can give the lender a lien on the property if you want. You can structure a JV agreement that says that they are in their entity, you're in your entity. They're not actually buying shares of your company or anything like that. So if you can prevent them from actually owning shares of the LLC directly, we have seen that to be circumventing selling direct, like selling security. But again, I should say right now, I'm not a lawyer, but I hire really good ones. And so my really good lawyers have told me that the joint ventures are not subject to SEC laws as long as you structure it the right way.
Yeah.
Your listeners should talk to lawyers, because lawyers are educated and can give really good advice on this kind of stuff.
I agree. Like Robert Kiyosaki said, hire good people and pay them well.
Yeah. Yep. Yeah. You don't have to know all the answers. You just need to know who to go to that has them. And pay for the answers.
Yeah. So I say, that's what Henry Ford did. People accuse him of not being really smart. He said, I don't have to be. I can hit a button anywhere on my desk and have the right guy come in to give me the right answer.
Yeah.
Yeah. Hey, I tell you what, Matt, we're getting close to time here, and I really appreciate you taking your time to do this. A lot of good, solid information on this one. This was one of my favorite ones. But anything you can think of is before we sign off, and maybe like a big why, like is there, like, for example, something that drives you personally? I mean, obviously the common denominator is we're all generating wealth and income, but maybe there's a reason why you're doing that. Maybe if there's something like that you don't mind sharing, because I want people to hear and see. They might be able to see a little bit of you in them, because sometimes they struggle. And if you have that anchor, you got that, your parent, you want to build you don't want them to go to nursing home, you want to live with you want to build an in-law suite, whatever, something like that, that's like an emotional pull. I've found out even when things go sideways, you keep that golden nugget in front of you, you always get back on track. That's so just an example. If you just want to share words of wisdom, I think people would be glad to hear that.
Well, you want to get to my why. I mean, I want to elevate my life, and I want to pull as many people along with me as I can, and so that might look like my wife and I give back a good amount of the money that we make to other organizations, not just our church, but yes, our church, but we also give back to other donating organizations. We give of our time. We give of our time, talent, and treasure as best we can. We have had like volunteer occasions, like gone away and just done volunteer work as our vacation in the past, and we continue to do that. And so we want to give and support to others in some way in whatever possible. And I try and do that through my education as well, through teaching others. I don't just contribute to Bigger Pockets, or I didn't just write a book so I could sell it and make money with it. I wrote it so I could share with others what I've learned, so I can help other people elevate their game. I contribute to Bigger Pockets because I love helping other people, not just because I get paid to do it, but because it helps me contribute to others. And so contributing to others and helping people, everybody, let's all pull up our game together, is my passion. And so that's my why. It's well beyond making money. Yeah, sure, I make money doing what I do because it's not a hobby. I get that, but it's also part of my passion to serve others as best I can.
Yeah, well, that's pretty good stuff there. I appreciate you doing it. I know for me personally, I'm grateful for you and what you do for the investor community, because I know I didn't get where I am all by myself. I definitely had help, and I got paid for some good mentors along the way, joined some good mastermind groups, things like that.
Yep.
But a lot of it came down to just personal relationships with guys like you. And so I think I speak for a lot of people when I say thank you for paying it forward,
Thank you. A lot of people helped me when I first got started too, so I'm just returning the favor.
That's it.
Cool. Thank you. If you want to hear more about what we're doing, they can just go to DeRosaGroup.com. That's DEROSA, DeRosaGroup.com. And they can pick up a copy of my book, Raising Private Capital there. They can sign up for our newsletter. They can look at some of the projects we're up to. They can contact us. We've got, like coaching programs that are going to be rolling out soon, so they can sign up for that as well. And they can just, keep in touch with us in general off of our website, which is DeRosaGroup.com, and that has everything you want to know, different facets, everything from learning how to invest with us to learning how to learn from us, any of those things in between.
Excellent. Well, and so the book, they can get the book online too from the website?
They can get it on Amazon. They can get it off of Bigger Pockets. Or they can get it off of my website too. My website's really just going to funnel them to Bigger Pockets. Bigger Pockets is the best place to buy the book because the Bigger Pockets includes a lot of free bonus stuff. So the best place to get it is on biggerpockets.com, but you can also get it on Amazon too.
Okay, awesome. All right. Okay, guys. And by the way, I'll put that in, make sure in the show notes. But for everybody listening, thank you for participating. God bless you and your families. And Matt, you too, God bless you and your family. And I look forward to seeing you at the next event, man.
Thank you.
Thanks for listening to this episode of Real Estate Investing for Professional Men and Women. Be sure to go to myinvestmentservices.com to join our community and start building wealth today.